Okay, we are live. And so for today's live stream, we are going to talk about some statements that have been made by a number of high profile CEOs of major, very large corporations. And what they're talking about is how they see the need to increase prices. And we're going to talk about exactly what that means for the economy. What does that mean for inflation, right? They have the title of CEO attached to their names, and it sounds a little scary, but let's get into that. You know, so if you're new to this channel, I'm an economist, and my channel is about unwinding some of the clickbait headlines that are in the news. By the way, I'm still having allergy problems, so uh, excuse me on that front. But anyways, yeah. So the topic for today is, how far can CEOs actually drive up the prices of goods and services in the economy? What impact do they have? And we're going to get into that. But first, just a quick note. Like I said, I'm having allergies. I was not able to upload for a couple of weeks because I got sick. It's just a regular a cold. And then I also had some technical problems with streaming stuff because I'm new to this. So I would ask you to please bear with me as I work through these technical issues. And I think the big thing right now is I'm very congested. Sorry for bringing that up, but I just want to let you know if you hear any breathing and stuff, I'm still dealing with allergy issues. But anyways, let's jump into the topic of the day. We're going to talk about it, look at some data, right? And then I'm going to give you my final thoughts and takeaways. So with that in mind, um, there was an article in Insider. It used to be called Insider Business, but now it's called Insider. And this is not the only article that were quoting these CEOs, but I saw this in the news quite a bit, and I thought, you know what, I'd better talk about this. I'd better address this because, as the title says, the CEOs of major companies are increasingly talking about inflation. And here's what has three of them worried, right? So they're quoting three. I'm sure there are other, in fact, I know there are other CEOs that are talking about price increases because what's really driving all this talk is the supply chain management issues that I've discussed before, right? So when we talked about inflation, you know, um, in my previous videos, I mean, we talked about how the big question is, yes, there's inflation, but the policy uh, question really has to do with how long will it last, whether it's temporary, whatever that means, and whether it's a sustained increase in prices that's going to continue on for multiple years or even longer. So that's the policy question that's being faced by the Federal Reserve. That's the question that is being tackled by the current Biden administration, especially the Treasury Department. And of course, now the CEOs are having to deal with this question, right? Because with the pandemic, with the COVID safety protocols, we all know that there are supply chain management issues, and these individuals are in charge of the companies that are trying to tackle those disruptions in the supply chain. And so there's a lot of things going on here, behind the headlines, and a lot of policy implications in terms of what they're actually talking about. So let's continue on. So the first, okay, so before we get into that, just to set the stage, like I was saying, inflation is on the rise. The economy's opening, right? There's a post-COVID recovery, although, I mean, it's not really post-COVID because it's still around, but the economy is opening up, and that's good for many, many people. A lot of jobs have been recovered uh, that were lost during the lockdown. And of course, like I said, the Biden administration and the Fed says price increases should be temporary. But the CEOs of major companies are saying that higher prices could persist, right? And it's no surprise there because the CEOs are the ones who are having to deal with these price pressures. The cost of raw materials, the cost of labor, is costing them more. They're having major problems on both sides of that those business resources, right? And we've also talked quite a bit about the labor market shortages. So if you're interested in that, check out my other videos. But anyways, to press on. Um, so the article notes that you know I think this statement was made in early July. Labor Secretary Marty Walsh said that he's not worried about inflation, and is quoting him as saying, the one thing that we are not concerned about is inflation. We're still in transition, so we're not concerned about that. So I think anytime we can push for higher wages, and the president's been very vocal about on this, that's a good thing for for people. So let's pause here real quick and talk about what his perspective. What is he really saying? So this is not an economist statement. I'm sure he probably is an economist, to be a labor secretary. Certainly competent in, understanding economic data and finance and all that stuff. But this is not an economic statement or economic assessment of the economy. This is a political statement. What he's really saying is, in order for us to do well um, in the polls and in terms of the public opinion, we've decided that the most important thing to do is to open up the economy and have a steadily increasing jobs recovery. Jobs is the number one concern of the public, understandably, and that's really what he's saying. You know, Obviously, when you open up the economy, you're going to increase demand, you're going to increase spending, and the inflation is going to go up. But he's saying, on the net balance of it, he feels that the job recovery is more beneficial to the public than what he considers to be a temporary increase in prices. And there is a very solid, valid argument to be made, for what he's saying. In fact, overall, I would tend to agree, right? If people um, were put to ask that question, say, do you want your jobs back, even if it meant somewhat a slight or significant increase in prices? I think most people would say, yeah, I want my job back because I need to pay the rent, right? So what Labor Secretary Marty Walsh is really saying is, we are making a political calculation that opening up the economy is more important to the public than some of the uh, arcane calculations about inflation, which he also considers to be temporary anyway. So you know, and so I've said it before in this channel, we absolutely stay away from politics and any kind of partisanship. As economists, I think you'll find that when we talk about economic data, we are very neutral, nonpartisan, right? And that's the tone that I want to set in this video as well. So this is not about politics, okay? But to continue on, excuse me, like I said, my allergies. So this is a quote from Jamie Dimon of Chase. And basically what he's saying is, I think it'll be a little bit worse than what the Fed thinks. I don't think it's only temporary. In June, Insider reported that Dimon said the bank was stockpiling 500 billion in cash in anticipation of higher inflation, during which he expressed the same concerns with the nature of inflation and that it will be more persistent than what people are saying. Okay, so let me address a couple of issues here, right? And the first thing is, I think the statement about stockpiling 500 billion in cash needs some explanation. It's probably lacking some context or proper context when he said it, because on the face of it, it doesn't really make a whole lot of sense, right? Because um, if you're really worried about inflation, why would you be stockpiling cash? The problem with inflation is that it erodes your purchasing power, right? Any cash that you have, in your banking accounts are going to go down in value, right? So I'm not quite understanding what he meant by that. I'm sure there is a valid reason for why he said that, but it's a little bit mystifying to me, right? Because you know how it is. when people are feeling like, inflation is going up and their paper money, the cash is going to be worthless, they're going to start investing in havens like gold, or crazy enough, some people have actually tried to do that with cryptocurrency. Um, and all I can say is stay away from that. But in any case, the statement about 500 billion in cash being stockpiled as a uh, hedge against inflation doesn't really make much sense here, right? The other thing I want to say about that is actually I used to work for Bank One right at the time where Jamie Dimon was hired as CEO. We all heard about the CEO executive search, and I'll be honest with you, I was sitting in an office with a friend, Bob, you know, and when we heard about it, we kind of laughed because he was so young, right? I mean, not to uh, uh, no insult meant uh, to Mr. Diamond, but you know, you know, uh, our honest reaction was, "Wow, he is so young." And we kind of laughed about it and joked about it and said, "Well, I don't know what's going to happen with the company." I will say that he has done a great job in terms of managing the corporation. Right? He's led it through the pandemic and all those other financial crises. So I'm not casting any aspersions to his management, uh, skill, but I do remember that story of sitting in the office and joking about the fact that he'd recently been hired. And I think there was a quote that he had about how well, there was a little bit of outrage in the media about how much he was being paid, and so he put out a press release saying that his wife didn't think that he was being paid enough. So I don't know if that was a savvy move. Maybe it was, maybe no. But anyways, so the CEO of a major, one of the largest banks in this country, probably in the world, thinks that inflation is going to be more persistent than you know the, than the Fed. Um, what do I think about this? I think that's a valid opinion to have. I mean, the Fed could be wrong. I could be wrong. I don't think that I am. And we also need to be precise about what exactly do we mean by temporary and, and I've said before, as an economist, I think temporary, I would consider anything less than a year to be temporary. So I do expect inflation to start moderating sometime early next year. And in fact, some of the early data on inflation is starting to show that. Okay, so I'm going to do another inflation update, digging more into that data, hopefully by tomorrow. But in any case, so he's a bank CEO, and he could be right. So let's continue on with the quotes. Okay, so this is a quote from another CEO. Let me bring that up on the screen, and he's saying, "I'm hearing from every CEO that they have huge price increases and they're passing them on across the board here in the United States and in Europe." Uh, you know, and so this question really goes to the heart of what we were asking, right? Which is, if the CEOs are saying that inflation is going to persist, and they kind of wave the white flag and saying, "Hey, you know what? The cost of our raw material, the cost of labor, it's going to stay high, and that means unless we want to lose our shirts, we need to increase prices, um, to match that, so that we can retain our profit margin." And so he's talking about doing that himself. He's talking about other CEOs passing on the price increases to their consumers. And if that happens on a mass scale, that could actually result in a sizable increase in inflation. So um, there's an additional quote for him. He's talking about how uh, policymakers. He's talking about the Biden administration, really, are saying jobs are more important than consumerism. And that is probably going to lead to that is going to probably lead to systematically more inflation. In fact, he's right. This statement is actually echoing what was said by Labor Secretary. Here we go. Sorry. Okay, yeah, Labor Secretary Marty Walsh. He's saying the same thing, right? That they're prioritizing job gains over what they consider to be a temporary increase in inflation, right? And so, um, yeah, so Fink is also saying, yeah, I mean, if you're going to prioritize opening up the economy at all cost, and you're making a bet that inflation is going to be temporary, then yeah, you're going to get some temporary inflation, right? But when he talks about systematically more inflation, he's really talking about how people going back to work are going to start earning an income, and um, there is this kind of money multiplier effect. People earn income, from their jobs. They're being paid their salary. They go out and spend money, and those businesses now have profit. They're going to pass on some of that money to their workers, and those workers are going to pass on the money that they earned and buy other stuff and so on and so forth. They have this kind of a domino chain effect, and so systematically, yes, it could lead to more inflation. But let's see what's happening. So continuing on, and so the CEO of PepsiCo. By the way, I don't want to sound snarky, but I prefer Coke. But in any case, um, I'm sorry, it's the CFO, Hugh Johnston, and he's saying, "Is there somewhat more inflationary pressure out there?" There is. He said that on an earnings call on July 13th. Are we going to be pricing to deal with it? We certainly are. Okay, so he's directly saying we're going to jump prices. We're going to increase prices. There's nothing we can do. Our inputs, that is the cost of production, has gone up, and we can't absorb that at the company level. Some of that, or all of that, really, is going to be passed on to consumers, and he's letting investors know. And when you say things like this on an earnings call, it's serious. It's official, right? You can't lie about this kind of stuff because you're going to get sued. You could probably lose your job, right? So statements made on an earnings call are legally consequential, right? So you don't say something unless you're serious about this. So um, you know, just to kind of sum things up, you know, here is the statement. Um, the CEO of Industrial Supplies Company, Holden Lewis, um, echoed the earnings call based on what cost is doing. He's saying cost of doing business is going up, so prices have to go up, right? And so he's saying that his company already had a price increase previously, obviously prior to the quarterly earnings call, and it was received quote unquote fairly well, meaning they didn't get a groundswell of screaming about the price increases. I'm sure people noticed, or the people who noticed weren't happy about it, but I guess there was no general uprising. There was no pitchforks in the night, at his house screaming that he'd be lynched or anything like that. So let's do a quick summation of what we are seeing here. Because if these CEOs are being quoted in the press about having to increase prices, and especially, even more importantly, if they are going on an earnings call and telling investors that the cost of business has gone up, as economists say, would say, in terms of the production function, there are two inputs, capital and labor. And if both capital and labor is becoming more costly to the business, then prices will have to, reflect that, right? So if these CEOs are going on the record saying that, it's pretty likely that a lot of senior management at a large number of companies are faced with the same decisions, right? Because this is a worldwide lockdown, a worldwide pandemic. The supply chain issues are hitting practically every industry, and it's global, right? And so, is this kind of like the canary in the coal mine, giving us a signal that inflation will continue to go up and that it may, in fact, persist more than we might think or we might want, right? So, let's go back to some data. Okay. Now, like I said, one of the things I really like to do is to kind of unwind the clickbait headlines and provide a more historical perspective that I think is useful for the public to consider, right? And so I've shown this chart before, but this is, um, historical data on inflation in this country, in the United States, going back to 1914. In 1918, we had that uh, huge, I think there was a huge banking crisis, um, and I think there was no FDIC back then and all that. There was a huge, massive financial crisis in this country, and inflation did go up to 20.44% during these times when inflation is negative. That's the Great Depression. You can see that in the 1930s. Um, so 1946, we still had 18% inflation. Going back to 1979, 1980, we had 12.5% inflation. So why am I talking about all this, right? What's the point of this? Well, first thing is it's nice to have a perspective and say, hey, you know what? Our current inflation rate is maybe 3 or 4%. And you look back on the past history of this country, 3 and 4% is being talked about as if it's hyperinflation. 3 and 4%, 3 to 4% is being talked about as if it's some sort of doomsday number, right? I'm not saying that it's insignificant, right? I'm not saying that it's not impacting the lives of people, but it's pretty low. When you look at this chart, it's pretty really low, and the reason why it feels like it's such a higher number, and when we get into 2021, we see that the inflation rate, the nominal, sorry, not nominal, but inflation rate is almost 5%, right? And the reason why it feels like this is um, such a big increase is because we have enjoyed periods of inflation where it was within the range of 2%. Now, 2% here, if you look at this of this data right here, I mean, going back historically, I mean, 2% is really, really low. It's I don't want to say that it's unsustainable, right? Because it's a balance of supply and demand. But to go from a, a historical period of really, really low inflation to an increase of still low inflation by no means is some sort of apocalyptic event for the economy. It simply isn't, right? And so let's say that the CEOs are correct and that inflation continues to go up a little bit more. It persists more than the Federal Reserve is anticipating. I simply want to say that is not by any means cataclysmic, right? There are things more important and there are greater challenges for the economy right now, for this country, than 1 or 2 point increase in inflation. Because I've said this many times before, right? Inflation isn't a thing, right? It is a measure of of supply and demand and the money supply and all those things. But you know, um, you look at it through a historical perspective, and you realize, okay, let's not talk about any huge implosion of the economy. There's talk about dangers in the press, you know, about that we're entering a whole new world of of the economy. No, no, we're not. Inflation has always fluctuated throughout the history of this country, and it's been far, far higher at uh, at various points in history. I thought it would be good to kind of remind us of that context, right? Now, let's talk more in depth about inflation because I think it would be helpful for us to have a refresher, right? Because I just said just now that inflation is not a thing, right? It's a measurement of underlying dynamics that are happening in the economy, and specifically for this current pandemic times, right? You know, for these current pandemic times, we're talking about supply chain issues, and we're also talking about major constraints on consumer demand because we were in a lockdown, right? And we still have a pandemic going on, right? People are still reluctant to go watch the movies. There's reluctance on many parts of the country about going out and eating out and going to concerts or sporting events or all those kind of things. So, looking at the supply side, looking at the demand side, right? Um, those are the things that we really need to focus on if we want to understand and diagnose the economy. Um, and inflation can be taken as kind of a signaling to us, especially as economists, and saying, okay, what's the underlying factors in this economy that are driving these numbers? So let's just do a quick primer on something that, I talked about this before, but, this is an article from Investopedia. I do like this website. It's free and it's got lots of good information, but looking at this text here, there are four main drivers behind inflation. Among them are cost plus inflation, or the decrease in the aggregate supply of goods and services stemming from an increase in the cost of production, and demand pull inflation, or the increase in aggregate demand categorized by the four sections of the macroeconomy: households, business, governments, and foreign buyers. The other two contributing factors to inflation include an increase in the money supply and a decrease in the demand for money. Okay, so with regards to the money supply and the demand for money, we're going to set that aside because that is not the big consideration here in this post pandemic economy, right? What we're really talking about is supply chain issues and an explosion of consumer demand that's happening right now or not happening, right? So um, we talked about before about supply chain issues. So when we talk about the problems with inflation, don't think of it as saying inflation is the problem. Think of it as saying inflation is signaling fundamental problems in the economy, right? So whether inflation is going to be temporary, whether it's going to be more enduring, you cannot answer that question by only looking at the inflation number, right? You have to look at the causal factors. And in this case, it's primarily uh, the supply chain issues, right? Right now, we were under a lockdown. We came out. There was a massive surge in consumer demand. There was, what economists call aggregate demand, and that was understandable. People had money to spend, right? They were in lockdown. They couldn't spend any money, and then when they came out, they decided, okay, now it's time to spend some money. So that's already there, right? Demand pull. That demand is pulling goods and services through the economy, and then we've got on the other side, the supply chain issues, right? And so when we talk about trying to figure out, why would inflation be temporary or more sustained, right? It really comes down to supply chain issues, right? I mean, there's all this talk in the media about the chip shortage. I think that particular shortage is probably going to be a longer lasting, right? About how that's constraining sales of cars because cars are basically roving computers now. Um, there are lots of constraints and whatever uses computer chips. For example, like cameras. You know, so that drag on the economy that is limiting supply is the primary factor of whether it's going to be long term or short term. And what we know. about businesses is that they are massively, massively incentivized to fix these problems. In fact, they're actually very good at it, right? I went to MBA school and I studied supply chain management. We talked all about all this kind of stuff, push pull, demand systems and so on and so forth. So I expect that there are a number of very, very smart individuals at a huge number of companies working on these issues, finding a way around these pandemic problems, about the safety protocols and all those things. And they are a significant problem, but they are working on it, and they are actually very good at resolving these issues because that's their livelihood, right? They could lose their jobs if they don't do this. Okay, so they are highly motivated. So it all comes down to your impression or your assessment of how long it's going to take to fix those supply chain issues. My feeling is that it's mostly going to go away by early next year, right? Otherwise, we are really in trouble, you know. So that's the takeaway, right? Okay. When you're trying to decide whether inflation is going to be impacted by CEOs or whether it's going to be long term or short term, you got to drill down, look at the underlying causal factors, right? And the assessment of the Fed's assessment of the Biden administration, and my personal opinion is that it is temporary, right? So, the whole thing about the CEOs, it's a little scary, but you know what? It's ultimately not up to them in the sense that they actually determine the level of pricing in the economy. The way they really actually impact inflation is whether how successful they are in terms of solving the supply chain issues. I wish they would focus on that instead of sending out these kinds of interviews. But anyways, they don't work for me. So that's my conclusion for today with regards to inflation. I'm going to provide more data to back up my claim that inflation is not going to last as long as some people are thinking in the next podcast. So look out for that. And until then, I hope you found this useful, and I'll see you in the next video.